In part 3, we will see the commercial bank determinants of money supply. That depends upon the commercial bank desire to hold excess reserve. This desired excess reserve ratio held by commercial banks depends upon three factors. Number one is market interest rate on loan. Number two is interest rate on borrowed reserve. And number three is risk of deposit withdrawal. So we will see all the three factors one by one in detail. Commercial banks keep total reserve, which basically comprised of two components, required reserve and excess reserve. Now you have to be very clear what is the difference between required reserve and excess reserve. Required reserve basically comprised of two components. Number one is the SLR, statutory liquidity ratio, and number two is CRR, cash reserve ratio. Now the question is, what is the basic difference between SLR and CRR? SLR means statutory liquidity ratio. Now what is the meaning of statutory? It means relating to rules or laws which have been formulated. Now who makes this law? The laws are made by the government. So this SLR is basically decided by the government. In India, statutory liquidity ratio is the government term for reserve requirement that commercial banks are required to maintain in the form of cash, gold, government bonds, and other RBI approved securities before providing credit to the customers. Now, another important point is SLR is typically defined as the ratio of bank's liquid asset to bank's net demand and time liability. So now this SLR is fixed by the government, but commercial bank keep this SLR with RBI because RBI is also the banker of the government. So basically RBI maintains this SLR. It is kept with the RBI by all commercial banks on the direction of the government. Coming on to the CRR. What is this CRR? CRR is the percentage of money which the bank has to keep with RBI in form of cash. So now you should be very clear that SLR is fixed by the government and CRR is fixed by the central bank. Both SLR and CRR are the reserves which are required by the commercial banks to keep with the RBI, that is Central Bank of India. Now coming to the excess reserve. This excess reserve is the reserve which is over and above the required reserve. That is what commercial banks are keeping over and above the SLR of the government and CRR of RBI is called the excess reserve. If commercial banks do not keep any excess reserve, it is said that commercial banks are loaned up and excess reserve of the banks is zero. So now this excess reserve plays very important role in the determinant of money supply. It is called as the desired excess reserve ratio, which commercial banks keep with themselves over and above the required reserve. If you see this money supply equation, this is the desired excess reserve ratio of the commercial banks, which is the part of the money multiplier. If commercial bank increase this excess reserve ratio, it is going to reduce the whole value of multiplier, and in turn it is going to reduce the money supply in the country at a given monetary base. So now the question comes, what are the factors which influence the desired excess reserve ratio, that is excess reserve upon deposit? So the desired excess reserve ratio of the commercial bank depends upon the market interest rate on loans, interest rate on borrowed reserve, and risk of deposit withdrawal. So let's understand all the three factors one by one in the coming slides. The first factor which influence the commercial bank determinants of money supply in the economy is market interest rate on loans, which influence the desired excess reserve ratio, that is excess reserve held by the commercial banks. We all know that excess reserve is the reserve over and above the required reserve held by the commercial banks, and this excess reserve earns no interest for the commercial banks. So we can say that interest rates are the opportunity cost of holding excess reserve, because opportunity cost means sacrificing the next best alternative. So when a bank holds excess reserve, it forgoes the interest which it could have earned by making a loan from those reserves. So interest rate is the next best alternative of holding reserve. So if bank lend that reserve to the market, bank could have earned interest income on it. Now imagine higher market interest rate on loan. This is going to increase the opportunity cost of holding excess reserve of the commercial banks. As a result, banks will going to reduce the desired excess reserve ratio. So if the excess reserve ratio of commercial banks is reduced, it is going to increase the whole value of this multiplier. As a result, money supply will increase for a given monetary base. But if the market interest rate on loans are very low, it is going to reduce the opportunity cost of holding desired excess reserve and encourage the banks to hold more and more of excess reserve. So if excess reserve will increase, the whole value of multiplier will be affected. It will fall down. As a result, it will reduce the money supply for a given monetary base. The second factor which influences the commercial bank determinant of money supply in the economy is interest rate on borrowed reserve. We all know that total reserve of the commercial banks are required reserve and excess reserve. Now, if banks are very obedient and decides not to hold any excess reserve, that means excess reserves are zero and banks are loaned up. So whatever reserve banks have is in the form of CRR and SLR. Now, in this situation, banks must view their ability to borrow reserve in the time of need as a substitute of holding this excess reserve. Now, it is important to understand what is the time of need of the bank. Like other business entity, banks are also a business entity. They receives deposit from the depositor and lend that to the borrower and earn the profit, that is the difference in the interest rate, which is the profit of the commercial banks. But at the same time, banks also have a liability to repay the money back to the depositor whenever they demand. So this can be done in a regular basis. When banks receive the new deposit, it just adjusts it by lending it to the depositor. But there might be a situation that banks do not have deposit to meet its liability for the depositors, because banks are completely loaned up. They don't have excess reserve. So in that situation, bank must view the ability to borrow reserve in the time of need, as it is not holding any excess reserve. So in that situation, bank faces a sudden need of reserve. which can give rise to liquidity risk. What is this liquidity risk? Liquidity risk is the inability of the financial intermediaries to serve its liability as they fall due. So if banks are unable to serve its liability, cannot refund the money back to the depositors, bank can fall in liquidity risk. So funding the liquidity risk can be done by two ways. Either bank can go for calling in loan, that is whatever loan bank has given will ask the borrower to repay it back, or bank can also have a power to borrow. It can borrow from other banks or it can borrow from the central bank. So borrowing from other bank can be done through interbank market, which allow banks to smooth out its temporary shortage of fund and avoid the liquidity risk. Or bank can also borrow from the central bank, that is Reserve Bank of India, which is also called as a banker's bank or a lender of last resort, and central bank lends money to commercial bank at a bank rate through its discount window. So in order to meet the liquidity risk, when banks do not have any desired excess reserve and it has a responsibility of repayment of money of the depositors. So since it is the liability of the bank which bank has to meet, and in such situation bank faces a sudden need of reserve which can lead to liquidity risk. This liquidity risk can be met through calling in loan. That means commercial bank being a lender can demand the repayment of loan from its borrower anytime. That is why it's called as calling in loan. Or it can make the arrangement to meet the liquidity risk through borrowing. It can borrow either from other bank or from the central bank. If commercial banks are borrowing from other bank, it is done in interbank lending market. Now what is this interbank lending market? It is the market in which bank lend fund to one another for a specified term. Most interbank loans are for short maturity of 1 week or less, majority being over the day. Such loans are made at interbank rate, also called as overnight rate when the term of loan is overnight. Or commercial bank can also borrow from central bank at bank rate. Now what is this bank rate? Bank rate is the rate at which RBI lends money to commercial bank. Now the important question that comes here is either commercial bank can borrow from other bank or from the central bank. What is the interest rate commercial bank has to pay as a cost of borrowing of fund to avoid its liquidity risk and to meet its obligation of the depositor? This interest rate influence the commercial bank desire to hold excess reserve, which in turn influence the money supply in the economy. Let's take case 1. When the interest rates paid on borrowed reserve are very high, this is going to make the borrowing of the commercial bank less attractive. As a result, commercial bank desire to hold excess reserve will increase. If this desire to hold excess reserve will increase, it is going to reduce the whole value of money multiplier and in turn reduce the money supply in the economy for a given monetary base. Now let's take case 2. If the interest rate paid on borrowed reserve falls, then it is going to make the borrowing option of the commercial bank relatively more attractive. As a result, the commercial bank desire to hold excess reserve decreases. This decrease in desire to hold excess reserve will increase the value of money multiplier and in turn increase the money supply in the economy for a given monetary base. So from this, it is very much clear that if the borrowing of the commercial banks become very costly because of the rise in the interbank rate or the bank rate. The desire to hold excess reserve of the commercial bank will increase, and therefore it would reduce the money supply in the economy. The third factor which influences the commercial bank determinant of money supply in the economy is risk of deposit withdrawal. Commercial banks hold excess reserve mostly to help themselves to deal with unexpected withdrawal. Let's take a recent example of land sinking issue in Joshimath, the tsunami of Andaman Nicobar in 2004, Bhuj earthquake in 2001, flood in Kerala in 2018, cyclone in Odisha. All these natural calamities lead to huge loss of life and property. In this situation, banks face the sudden need of withdrawal. Banks of these areas therefore are forced to hold desired excess reserve or additional excess reserve in anticipation of people withdrawing funds to repair their homes and other basic necessities. Such type of event leads to increase the desired excess reserve of the commercial banks. So if there is more of risk of such withdrawal, bank is going to keep more of desired excess reserve to meet the unexpected withdrawal by its depositors. The desired excess reserve kept by the bank would help the bank to avoid calling in loans, selling its security and borrowing from other banks or from RBI. Thus, we can say that higher the risk of such withdrawal, higher the desired excess reserve ratio. If the desired excess reserve ratio will increase, it will reduce the value of multiplier. As a result, the money supply in the economy will fall for a given monetary base. If you have any questions on this presentation, please leave your questions in the comment section and like and subscribe my channel to get further notifications. Thank you so much.